everybody who's taken the time out to join us. Thank you very much. This is an ongoing series of webinars where we talk to industry experts to tell us about their thoughts, share their insights about what's happening and how should all of us handle this and what it means for each of us individually and for us as a company. So without further ado, I'll sort of introduce our esteemed panelists. We are actually very privileged to have Rahul Singh with us. His CV reads like a complete copybook. He's an IIT IM graduate. He's had over 20 years of hardcore equity research experience before becoming a fund manager. He had his own startup. Now he is the CIO of Tata Mutual Fund. So a man with tremendous amounts of experience. So we thank you, Rahul, very much for taking the time out and joining us. I'll hand over to Rahul in a couple of minutes. Just to give everybody the context, we've had a series of these webinars. We've touched upon a few topics about expectations in the market. What should an individual investor do? Should he remain invested, etc., investment philosophies. Today, the topic is slightly different. We are actually going to pick on Rahul's experience and his approach to tell us about two topics. One is about how are they seeing investor behavior. So people like you and me who invest in mutual funds, how have investors reacted, what kind of questions they're asking, and how is Tata Mutual Fund taking care of those concerns and those needs. The other question is about the broader economy, but from a consumer perspective. So how are consumers behaving and how they're likely to behave as we go forward, given the changes in all around us, and what the implications of that are to their investment philosophy. So the format is as usual. Rahul will share his thoughts and ideas on these two topics. And as we go along, I'll ask questions which I feel the audience asks. The chat window is open, and as you shoot the questions as asked, we'll pass them on to Rahul. I'll moderate. The only request is that if you're not able to get to all your questions and we're not able to answer every one of them, we are noting them down and we will definitely get back to you, if not during the webinar because we are time constrained, but we'll definitely reach out and try to answer your questions to the best of our ability. So now over to you, Rahul. Thank you once again for joining us. Please let us know. Tell us a little bit about yourself, introduce yourself, and then tell us a little bit about Tata Mutual Fund, and then the two pressing questions around investor behavior and consumer behavior.
Sure. Thank you, Atul, and thank you for this opportunity. It's good that in the current scenario we are able to do this and reach out to more people digitally, which would ordinarily not have occurred to us. So that's a silver lining I'm seeing in a lot of interactions I'm having, and I think it's some play at some time in some ways it is democratizing the availability of knowledge for a lot of people who would not have got access to a lot of webinars or so on otherwise. So just a little bit of myself, like Atul has already said, I come from a hardcore equity research background, and I think I've worked in organizations of very, very different types and size and shapes, starting with the local brokerage called SSKI, then Citi, then Standard Chartered. And I can tell you that all of them have added something or the other in my way of working. So I think SSKI was very entrepreneurial, very, very risk-taking in a way, which actually taught me that if you're in equities, you have to take some risks. When we came to Citi and Standard Chartered, very system-driven, very process-driven, at times very bureaucratic. But also told me that there's no big bank which is immune to failure, because I was in Citi during the global financial crisis. I was in Standard Chartered during the debt crisis of 2013 to 15. So in a way, it's been a very humbling experience even to be part of those big organizations and still realize that there are events which happen globally which you have no control over, and even big banks and big organizations go through some real pressure, can go through some real pressure if not managed well. And that brings me to the point, to the first question which Atul was asking about the investor behavior during these times. Now, I think the investor behavior this time in the domestic mutual fund, at least from a domestic investor point of view, has been very, very, I would say, matured. In the sense that we did not see panic redemptions in March and April. And we are seeing redemptions now I mean, not a big wave, but you've seen the industry numbers that there have been redemptions in May, and I think some of it might continue in June. So I think the people or the investors in mutual funds are realizing that we are going to be in for a little bit of a turbulence going ahead, despite the fact that we have had a very decent rally and we have retraced almost 30% of the decline. I think everyone knows that we are not out of the woods, and are paying much more attention to their overall equity proportion in their investments. And I think that's the starting point for me. And there is one advice which I give at every forum, and I would like to repeat here. And it might sound like common sense, but believe me, that is something which is very, very useful. And I think people are doing those kind of assessment and therefore reducing their equity proportion wherever they feel that there is a need. So the extreme examples I would like to give here is that if you look at someone who is working in industry which has been directly impacted by COVID, for example, if someone is working in hospitality industry or aviation industry, and assuming they still have their jobs, I think, and if they are running a portfolio of their investments, which is 70-80% into equities, I think there is a need for caution. And I think one needs to take into account the fact that the job prospect or the income prospects for those kind of people is not the same as it was post-COVID. So they need to conserve savings. And if you are 70-80% in equities with that kind of a job profile, you need to tone it down. You need to bring it down. So the reason I'm giving this example is that there is no one answer for everyone. It's horses for courses. Similarly, if someone is working in IT industry, and I assume that in Bangalore, a large majority of people would be from that industry, or if you're working in an FMCG industry as an investor, or if you have a client who is an investor, who is working in FMCG industry or IT industry, I would think that the income profile or the salary outlook for those kind of sectors are pretty stable. So therefore, I would not mind that investor to be really more than 50-60% in equities, despite the fact that there has been a run-up. Obviously, you can manage your equity proportion pretty well by being in a combination of sectoral funds, large and mid cap, balanced advantage fund, and so on. But the starting point has to be, what are your level of savings? What is your job security? Where are your savings where are your savings today, currently? And do you need to realign your equity proportion of the investments or savings given the change in the scenario post-COVID? So I think that's the guiding principle which I would like to advise. And I think knowingly or unknowingly, or consciously or subconsciously, some people might be doing this, what I am kind of advising, and which is why you are seeing May and June little bit of kind of profit booking.
Thanks. I'll just add to that, Rahul. Absolutely. I mean, a couple of points. I mean, just to reiterate. So one of the things we've been telling our customers at Scriptbox is to first top up the emergency fund. So we've clearly been saying that have at least 6 to 9 months of expenses in an emergency fund, in liquid funds. So whatever your situation is, and especially in these industries Rahul was mentioning, we reiterate that. And the second piece, which he again spoke about, is about asset allocation, which is very personal and circumstantial. So talk to your advisor, talk to people about how much money should be in different parts. And Rahul, just to add one, sorry, this is not a sales pitch for Scriptbox, but though, yeah, we are Bangalore based, we are not Bangalore biased. We've got customers in 1250 cities. So we are an omnipresent kind of place. Yes, but because we are digital, we do have some of our customers. The customer base is tech savvy and tech based. But sorry, back to you. So you were telling us that take an individual call based on your circumstances as to how much equity exposure you have and how much savings you have. I just want to add from our perspective what we've been telling our clients that this is consistent with. Thank you very much for that. Over to you about consumer behavior.
Yeah, I think that brings me to the second question, which actually is more interesting and more kind of more. Let me put it this way: more useful for a fund manager to crack, because a lot of things are going to change and have already changed in terms of the consumer behavior. We are seeing and we are going to see obviously more and more. So let me tell you some examples of that so that you get a sense of how we are thinking and what we are doing in our portfolios. So two clear trends we see, and that has got direct implications for the stocks and the companies and the sectors we are increasing weightage and investing in. One is that when you have work from home environment, I think the importance of telecom network as a utility, as a must-have utility with a reliable telecom network, and your ability and willingness to pay for it. Ability was also there, always there, but your willingness to pay for a reliable network has gone up significantly, and I think that helps the sector, because telecom sector has gone through some real tough times over the last 8-10 years. So now we are in a situation where the reliability of telecom network is very important, and therefore the consumers' willingness to pay more, even if it's 20, 30, 40, 50 rupees more, that's something which is very, very important. I think that will lead to this sector, in our view, doing really well over the next 2-3 years. I mean, that is very, very clear in our mind. And there are not too many companies to invest, but there are large companies to invest in this sector. So we are obviously very, very bullish on that sector. The other segment where I see a distinct behavior change is in the way of insurance. So if you look at today, life insurance is very, very underpenetrated market in India. When I say life insurance, I don't mean ULIPs, but I mean the pure term protection, protection insurance. And I think generally it's kind of seen as a useless or wasteful kind of a non-productive expenditure by a lot of people who don't have sufficient insurance premium or life insurance premium. I think that behavior will change. What we had seen post SARS in Asia when it had happened, that the life insurance premium sales went up by 30-40% over the next 2 to 3 years. So we think insurance as a segment is going to do well. That also includes health insurance. That also includes general insurance like business interruption insurance. So what we are going to see is that the behavior towards risk as an asset class was totally ignored, whether it's risk to your life, risk to your property, risk to your health. I think we are going to see those companies doing really well. So insurance as a segment, I think, is going to do really well. The other segments in not so much from a consumer behavior point of view, but from a geopolitical and a global point of view, is that this China plus one strategy, which started 3-4 years back when people started moving out of China because of high cost, has taken a new dimension because of the geopolitical tension, which started with US-China trade war, but has now worsened because of COVID. And I think India has, once in a decade opportunity to really capitalize on it. And I think government this time, for a change, is not sleeping, and they are very, very proactive. You have seen for electronic manufacturing some really good incentives being proposed. We have seen for pharma intermediates some really good schemes being proposed. So I'm very, very positive on industries like pharma, chemicals, electronic manufacturing, where I think India has an opportunity which is being given, it's once in a decade kind of opportunity. And I think thematically, next 5 years, we can continue to see good growth in some of these companies. So those are kind of three examples I would want to give as clear-cut opportunities. Okay. Apart from that, there are other opportunities like personal mobility. People would want to avoid crowds, so two-wheelers, entry-level two-wheelers, entry-level cars. Those are the kind of things which will see some demand uplift. Um, so those are well known and those are well documented. I thought I would highlight some of the things like telecom, insurance, outsourced manufacturing as some of the other opportunities which we are focusing on.
Thanks, Rahul. And in light of, see the constant battle for a retail investor is, which is the question we keep getting asked, should I start looking at sectors myself, or and how do you play that? Our approach is that the fund manager is the expert, so leave it to the fund manager to decide. So I'm sort of, what is your sense on that? That while there are segments which will keep changing over time, our advice has been that let the fund manager be transparent about what they're doing, but let them pick the right companies within each segment or each sector which they think. And as sectors sort of go through their own cycles, rather than be very narrow about one sector and put all your money there, leave it to the fund manager to invest in whatever whether it's in diversified or it's in large cap or it's in mid cap. But so how do you think about that, Rahul?
Yeah, I would agree. Not 100%, but at least 90%. Because I would want 10% of. Sectoral fund, what happens is that every 1 or 2 years there is huge rotation in the sector fund. So obviously, if someone is investing in a sector fund, he needs to be slightly more educated and knowledgeable and alert to know when to get in and get out, because these are funds which can do well for 1 or 2 years and then not do anything for the next 3 years. So that is the only kind of risk in some of these funds. I would think that my own sense is that at the maximum, maybe around 10% of anyone's investment should be in the sector funds. And to start with, I think the sector funds where you have a long-term track record of value creation is banking and consumer. So that those are good places to start from. That doesn't mean that every year you will make returns in those sector funds, but typically if you hold banking and consumer funds for long enough, 3 to 5 years, you do end up looking much better off. But the people who make best use of sector funds are the ones who are able to get in, get out. And I don't see, maybe that is something which is difficult for an individual investor to do. Maybe more for HNIs, but I think banking and consumer are the two sectors where I would think that if you put 10%, 15% of your investments in these two funds, you would not be worse off, at least relative to the rest of the market.
Done. And in terms of sort of your own investing philosophy in your more diversified or in your large cap funds, what's the typical churn you see over say a 3-year period across sectors, across companies? Obviously, these are extraordinary times, so it may be different. But what's your typical approach been, Rahul, at Tata Mutual Fund, and especially under your watch? What is the approach you all take, or is there a different thing for different funds? So just talk us a little bit more about the Tata Mutual Fund investing philosophy in terms of the various funds you manage, the various themes you all practice and chase.
So we have a philosophy which is known as growth at reasonable price. And so what you will not see with us is that we are not deep value investors. We don't like to buy things cheap just because they are cheap and wait for 5 years, 10 years for the value to emerge. I think that's a risky strategy in an Indian context. It has never worked. What we do, and on the other hand, we also do not believe in the philosophy of buying at any price, buying quality at any price, because the margin for error there is extremely small. So what we do focus on growth at reasonable price are basically three areas, which is we look at value with triggers. So we look at stocks which are cheap, but where we see something happening in the next 6 to 9 months, and that trigger could be just increase in earnings, or some kind of a corporate event, some kind of event like privatization in the case of PSUs, which is a theme which I think can catch on going forward. That's the number one segment. The number two segment within growth at reasonable price is what we call as earning upgrade cycle. Now let me explain this earning upgrade cycle. I think our thinking is that, and it has been borne out of facts. Our thinking is that if you identify a company or a sector which is at the beginning of an earning upgrade cycle, when I say earning upgrade cycle, essentially what I mean is that the expectation from the company is low, and you, basis your research, think that the company is going to go through multiple years of re-rating, something which is happening in telecom. I mean, it's a perfect example where we think that the industry structure has changed. COVID will make sure that the earnings will keep on going up. We go and take concentrated bets on those kind of sectors, and hold on till the full potential of the earnings is realized. And we've seen this working for us very well, which you can see it's neither fitting in the deep value philosophy or in the high quality, high price philosophy. So these are the two segments I would think which form the meat of our the core of our philosophy, and we follow that. So whatever I mentioned to you about, let's say, telecom or insurance, or the electronic manufacturing, you can see that they all form a part of these two or three guiding principles which we have under growth at reasonable price. Now, this philosophy calls for having lesser number of stocks but higher concentrated positions. So we have, typically in our portfolios, we have about 35 to 45 stocks, which is much lower than the street. So if you look at the rest of the mutual funds, you will have people having 60, 70, 80 stocks as well. You will not see us having that kind of a tail. Number one. Number two, our churn levels are lower than the street. We are probably, in a year, our churn levels will be between 30 to 50% in 1 year, or turnover ratio, whatever, like the way we call it. We call it portfolio turnover ratio. That's the common term which you can find in the fact sheets of all the mutual funds. If you compare it with the other peers out there, some of them are much higher. I mean, let me not give you numbers, you can look for yourself, but so that just tells you of our approach versus the approach which the rest of our peers have, which is of concentrated conviction bets, not very high churn, and playing under the buckets of growth at reasonable price, which is value with triggers and earning upgrades.
And in terms of for us to look forward over the next 2 to 3 years on behalf of our customers and investors, what's your sort of crystal ball gazing in terms of where do you think markets are going to go? Where do you think sort of value is going to get created? Like you said, telecom, or anything sort of the next 3 to 5 years? What's your sense of the industry, and also on the mutual fund industry as a category, from a distributor perspective, from the mutual fund industry itself? Do you see any structural changes? Do you see anything different coming out in the next, given the COVID impact and also where we are in our own life cycles of the business?
Yeah, I think the value will be created by apart from the sectors which I've already mentioned, telecom, insurance, and chemicals and pharma. I think the other sectors which are looking extremely promising as the IT services, where my own sense talking to the companies and getting feedback from them is that when the dust settles down post COVID, I think there's going to be more and more investment in digitization globally. I think more companies are going to invest more in their IT infrastructure and IT products. So I think that's one area I would be positive on. Again, the companies here are well known, but I think the sector has not got its due. So that's one sector where I think we think that there is going to be potential. The other sector which always does well, and I touched upon it when we were discussing the sectoral funds, is the banking fund, banking or rather the banking sector is. It's a compounding story. Banking sector is a compounding story. So if you have got a good bank which is earning 15 to 16, 17% ROE, and you buy it at a reasonable price, you're going to get, even if you buy a little bit expensive, you're going to get 10, 12% annualized return from there. I mean, in the current context, when the debt market yields are so low, 10, 12% in a high quality company or a high quality bank is a no-brainer. So I think if someone is going to be patient enough to ride through this 6 months of volatility of moratoriums, NPLs, and so on, I think banking is a sector which will come back and will come back quite strong. And remember that larger banks are going to benefit more, given the fact that all the deposits are going to them. And when the market comes back, they are going to look they're going to be invincible. So clearly, banking as a sector, although near-term volatility is there, I think we remain quite positive on that sector as well.
Okay, thank you very much. I'll throw the floor open for other questions from our audience. Thank you, Rahul. You've done. I mean, you've answered all my questions, and these are all audience questions we've collected over time. And people are keen to get your perspective on sectors, your investment philosophy. What should they be doing? I mean, any final piece of advice from your side in terms of what should our investors be doing going forward before I wrap up and give them my sort of thoughts, Rahul?
So I think given where the markets are and given where the economy is, I think given the level of uncertainty which we are still contending with, my own advice today would be to go for a diversified large and mid cap kind of a fund. The reason I would say that is because that's an all-weather fund. So it's very easy to get convinced and say, okay, let me buy a value fund or a mid cap fund or a small cap fund. But today, let me tell you that like the changes we discussed in the banking sector, I think the large companies are going to come out of this much stronger, specifically banks, but true for other companies also. So a large and mid cap category gives you that basic core of a large cap fund, large cap category, which gives you stability and 10-12% kind of compounding. Whereas the mid cap part, which is 30-35% of the portfolio, today also there are a lot of decent opportunities from a valuation point of view, where although the market has run up, I think the companies, some of the sectors I mentioned about the electronic manufacturing, chemicals, pharma, a large part of these 2-3 sectors is residing in the mid cap sector, in the mid cap segment. So if you are only in a large cap fund, you are going to miss out on some of these themes which I spoke about from a 5 to 10 year perspective. And therefore, I would strongly recommend, put it in a staggered manner. You have to ask people to put it in a staggered manner, because you know that next 3 to 6 months will be volatile. I mean, you will have bad weeks and you will have good weeks. Right now, we've had 3-4 good weeks. It's very, very likely that we'll have 2 bad weeks. But, the question is, what do you do then when you have a bad week? And therefore, I think large and mid cap that way is an all-weather fund. I love the category. I think it gives you the stability and solidity of a large cap, of buying a large cap which has good potential. And at the same time, some of the themes which I mentioned, you would not find large cap companies exploiting that theme. You will find mid cap companies exploiting that. So that's what I would like to end with. But having said that, I think you have to remember that if the investor is already in 80-90% equity, you have to treat him differently from an investor who is at 30-40% equity.
True.
And if an investor is already kind of worried about short-term volatility, then you're better off telling to him that, okay, in the next 6 months you be in a balanced advantage fund. If you don't want to put in staggered manner, it's fine. You be in balanced advantage fund, which will dynamically change the equity allocation and make you ride through the volatility.
Thank you so much, Rahul. I really appreciate your time and your advice to our investors and to us as wealth managers. So just to cap up, thank you. Our suggestion always to our investors is remain invested. It is a long-term game. Manage your asset allocation. Trust the advisor. This is what they do for a living. It's their interests are totally aligned to your interests. Trust the fund managers because they know what they're doing. They do deep research on the funds they're selecting. From a Scripbox perspective, we do have a product which actually helps you diversify your investment across different sub-asset classes. So reach out to us and hopefully we can meet your needs. And most importantly, stay safe, stay invested. Thank you everyone for joining us and taking the time out. We look forward to seeing you again soon with another webinar on another interesting topic. So thank you very much, Rahul, on behalf of everybody at Scripbox, and we hope to catch up again soon. Cheers.
Thank you, Atul. Thank you, everyone. Thank you.